welcome to Deloitte Tax's Indirect Tax Lifecycle video series. We'll have 5 episodes where we talk about the different areas of the indirect tax lifecycle. On today's episode, we're going to discuss nexus, classification, taxability, and sourcing. And on future episodes, we're going to discuss compliance, exposure and remediation, process reviews, and reverse audits. My name's Kirsten Galata, and I'm a principal based in New York City, and I lead Deloitte Tax's National Transaction Tax Practice. I'm here today with Rick Heller. Rick, thank you so much for joining.
Yes, thanks for having me, Kirsten.
So Rick, before we jump in, can you share with our viewers a little about yourself and your role at Deloitte?
Sure. As you mentioned, my name is Rick Heller, and I'm physically located in northern New Jersey, just outside of New York City. I serve as a managing director in Deloitte Tax's National Multi-State Specialty Tax Practice. As part of my role, I head up the Sales Use Transaction Tax Consulting service line, working for Kirsten, and I assist others internally and provide services for complex technology and telecommunications clients.
Thanks, Rick. So in the indirect tax world, there's been a lot of changes over the past few years, especially as it relates to sales and use tax and nexus. Can you tell us a little bit about that?
Sure. Since the Supreme Court's landmark ruling in the Wayfair case back in July 2018, that set aside the physical presence standard that companies and states have relied on for 60, 70 years. States rushed to pass new legislation creating economic nexus threshold statutes for nexus. And economic nexus theory is based on a dollar threshold or a transaction threshold. And those thresholds do vary from state to state. Some states look at all sales, other states just look at taxable sales. Some states look at the last calendar year, while other states might look at a rolling 12-month period. If companies with a traditionally limited nexus footprint based on physical presence sell remotely and haven't analyzed their nexus footprint in a while, those companies should take another look and see if they've triggered nexus in any states to determine their tax compliance obligations. As a best practice, limited nexus companies should periodically review economic presence nexus so they understand their obligations and they don't fall behind in their compliance obligations.
Thanks, Rick. So one of the other changes that we've seen recently is related to marketplace facilitators. Can you talk to us a little bit about that?
Absolutely. Marketplace facilitators in many states was passed hand in hand with economic nexus provisions. And states adopted these laws very, very quickly. If you think about the tax landscape and how things change in sales tax, they change very slowly over time. If we think about electronically downloaded computer software, it took the states about 10 or 12 years to all reach consensus on what to do with the taxation of these items and the sourcing of electronically downloaded software. But here, with marketplace facilitator laws, all states with a state level sales tax and other states like Alaska that just have city level taxes have passed some type of marketplace facilitator statute. And these statutes change the world of sales tax by shifting what's historically been the obligation of a vendor, the legal vendor of a good or service, to the marketplace provider. So now the marketplace provider needs to understand the intricate sourcing rules and taxability rules of things that flow through the marketplace facilitator's platform. This is a major shift to transfer that responsibility from a legal vendor of goods to the marketplace facilitator that is not in the chain of title of the goods and is not the purveyor of the goods. So this big change creates a lot of unforeseen problems for marketplace providers who are generally technology companies. They're software companies that build a platform. They're not necessarily logistics companies, and they don't necessarily have large tax departments to deal with the taxability of the transactions that might flow through their platform.
Yeah, so that must be really interesting for clients to navigate because there's no federal law to define services or to define sourcing, and there must be decisions on a state-by-state basis. So can you talk a little bit about that?
Yeah, Congress really hasn't stepped into the fray, although they've been asked to do so. Congress has gotten involved under the Commerce Clause a number of times when there's been sticky situations between states and sourcing transactions and how to tax them. So an example would be the Mobile Telecom Sourcing Act. If you think about a mobile phone, it travels from state to state. You could be having a conversation and drive from one state to another state, and there was lots of questions about how taxes should be applied to mobile phone service. Ultimately, Congress stepped in and passed the Mobile Telecom Sourcing Act, which provided uniform definitions that states had to use from state to state, and also provided uniform definitions regarding how to define taxable services. So Congress has been asked a number of times to get involved with regard to digital goods and services, electronic commerce, cloud services, but Congress just hasn't stepped in to do anything. So we're seeing many disputes regarding taxability on audits. Some state departments of revenue are trying to put services that are newly created into old buckets and applying tax to them. And that causes a lot of heartache for companies when they're involved in an audit, because some auditors are trying to expand the tax base through audit instead of the legislature expanding the tax base through the legislative process, which really gives people the proper notice and follows due process so the companies know what their obligations are and what they have to do to comply.
So, Rick, I know that you work with a number of different companies on these issues. Can you share a little bit about what Deloitte Tax can do to help companies with their challenges around nexus, classification, taxability, or sourcing?
Sure. When we work with technology-based cloud and digital services type companies, the first thing we do is dig in to understand what do they sell and how do they sell it? What do they provide the customer? And we need to understand that in order to then apply that knowledge to what's in the tax statutes and other guidance put out by a particular state. We have the experience and the specialists that focus on these areas exclusively. And then we take this ability and apply the nexus rules, the sourcing rules, the taxability rules to a particular client's set of circumstances. So we like to go through that process of really digging in and understanding the client. That means we take a broad approach to the client and we look at them holistically. So we look at, should the client be filing? Should they have been filing historically, or at least back to the economic nexus statute date in a particular state? And then we help them understand their obligations, help them with potential remediation, either going under an amnesty process into a state to ask for forgiveness and get some penalties and fees waived, or going in through a formal voluntary disclosure process with a particular state, or maybe they just need to register and file some late returns and move forward. The other thing we focus on is foreign inbound sellers, which I mentioned earlier. They really don't understand the US landscape, and there are a lot of complexities about selling into the US from abroad. So we provide assistance and advice regarding legal entity structure and mitigating tax exposure, both retroactively and prospectively as they do business into the future.
So I know we're focused on indirect taxes, but since they're so closely related, from an economic nexus standpoint, are there other direct tax considerations that should be made?
When we look at a company that hasn't been a client before, we never want to just look at their sales tax obligations. We also want to look at their state income tax obligations, as well as there's a number of state with gross receipts taxes. And those could take the form of a commercial activity tax, a business and occupation tax, or just a regular gross receipts tax. So when a remote seller is thinking about state tax nexus concerns, they really should look at it holistically from a multi-state perspective. And many people come in and just ask the sales tax question, and we really have to guide them and say, you really can't register for sales tax only if you have an income tax filing responsibility or you have a gross receipts tax filing responsibility. So we help clients look at the big picture, because many times they come in with a very narrow question because they don't really understand the landscape that's out there.
Amazing. Thank you so much, Rick. Really appreciated all of your insights today. Please join us on our next episode where we'll discuss compliance with Brian Little. Thank you.